Did the Fed's experiment fail? Yes, I have. Yes, it has. I gotta share with you why that is. Always don't forget to join me on Rumble and Locals. All right, so joshscanlon.locals.com and Rumble. Just type my name under the drop-down box that says channels. Just Josh Scanlon. Join me at both those places. All right, so let's go into this. This is from my man Lance Roberts, and I'm a big fan. I've become a big fan of Lance. And look, not everything. Wow, disagreements on certain things. That's crazy. But by and large, the boys over at Real Investment Advice, and that's all encompassing to ladies too. I like them a lot. I think they got a YouTube channel. All right, so this is from about a month or so ago. Did the Fed's monetary policy experiment fail? The recent dislocation between consumer confidence and the financial markets may indicate just that. U.S. consumer sentiment dropped sharply in early August to its lowest level in a decade. In a worrying sign for the economy, Americans gave faltering outlooks on everything from finances to inflation and employment. The big thing is inflation. I think everyone's like, oh my goodness, inflation is coming. But they don't know. I'm just telling you, man, that right there is what they want. They want you to think inflation is coming, thus spend your money now because in the future your money will be worth less. Then you say, explain Japan, and they'll use silliness like, oh, they have export surpluses. Okay, well, many other countries have export surpluses, and they're not in deflation like Japan. All right. However, to understand why I'm asking the question, says Lance, we have to revisit what Ben Bernanke said in 2010. The approach of ease financial conditions, i.e. quantitative easing, to infinity and beyond, in the past and so far looks to be effective. Stock prices rose, long-term interest rates fell. Easier financial conditions will promote economic growth. Really? Easier financial conditions will promote economic growth. It's kind of like the false flag of the modern monetary theorists. It's the same thing. It does until it doesn't. We can spend more money, create more debt, and that'll promote economic growth. Does it? For example, lower mortgage rates will make housing more affordable and allow more homeowners to refinance, actually increasing their take-home pay, essentially. Lower corporate bond rates will encourage investments. Again, because they have to pay less for interest rates and thus increasing their take-home pay to do other things with. And higher stock prices will boost consumer wealth and help increase confidence, which can spur spending. So look at what they're doing. Lower mortgage rates will make housing more affordable. All right. Does that make housing more affordable? Does it? No. Because the lower the mortgage rates, the higher the price of the house. This is just basic economics, man. Look, I'll give you an example, as always I do. People think you should move to Pennsylvania as opposed to New Jersey because in New Jersey property taxes are so high. Yeah, and I'm telling you, we did this 10 years ago when we were looking at moving to New Jersey and Pennsylvania. We said, we have to avoid New Jersey because it's too high property tax. Well, the price of a house in New Jersey is lower because the property taxes are higher. The price of a house in Pennsylvania is higher because the property taxes were lower. Nothing works in a vacuum here, man. People aren't stupid. So we ended up buying a wonderful place in New Jersey that was 15 minutes via train to Center City where I worked, where the same price we could have bought something in Downingtown, which is 55 minutes away via train. Because everyone's like, I'm not touching New Jersey, property taxes are too high. You're like, well, and that's what I thought too. And I said, whoa. This place called Haddonfield. It's a beautiful town. It's right next to the city of Philadelphia. You can walk to the train. So the property taxes were high. That meant the housing were more affordable from a price perspective. When all was said and done, it was even Steven though, except I was living closer. So my quality of life was much better. All right, but all the way to lower corporate bond rates will encourage investment. I tell you, man, why? Because of all this says is we're gonna invest, we're gonna borrow and leverage the borrowing for research and development and things of that nature, and to buy back stock and to buy back and pay your dividends. It's just bad. Let's see. It was all going to plan. Since the Fed began its monetary interventions, the correlation between asset price and confidence remains high. Here you go. Going back to 2009, consumer confidence Asset price, all good. And well, it makes sense. People are more confident when they have the wealth effect. That's a fact. Oh, but by the way, what if people don't borrow lower corporate bond rates? What if people say, I refuse, I'm not going to borrow? What if people say lower mortgage rates don't make my housing more affordable, actually, because they make the prices higher? Interesting. And that's exactly what happened in Japan, is that people said, I'm not borrowing. I don't care what the interest rates are. And I have anecdotal evidence here. I talk to people all the time. I've talked to this wealthy businessman who's a contractor in Missouri, wonderful guy. He says, after 2008, I will never borrow again. He said, I was able to survive by the skin of my teeth, man. He didn't take an income for 3 years. He paid his employees, but he just said, I just was able to get out of that. It was bad. He goes, I'll never go through it again. I don't care what the interest rates are. All right, let's keep going. It was all going to plan. Yep, right there. The problem was that with the Fed lifted asset prices, the economy did not strengthen as expected. Quantitative easing the Federal Reserve got the desired outcome of increasing asset prices, the inflation of assets, real estate, bonds. The prices of bonds are higher, which means the interest rates are lower. Stocks, Bitcoin. Now we got freaking baseball card collection. The assets are inflated. That's a fact, but they're not inflated by a strong economy. It's just not. Despite the massive expansion of the Fed's balance sheet and the surge in asset prices, there was a relatively little transition to wages, full-time employment, or corporate profits after tax, which ultimately triggered very little economic growth, 100%. Since 2007, the stock market returned nearly 200%, which is more than twice the growth of the GDP and nearly 4 times the growth in corporate revenue. Sales growth, as it happens at the top line of income statements, is not subject to much manipulation, 100%. Again, it was all going to plan, sort of, until now. Over the past half century, the sentiment index has only recorded larger losses than 6 other surveys, all connected to sudden negative changes in the economy, says economist from the University of Michigan, which does the consumer sentiment. 2 of those larger month-over-month movers were April 2020 amid the pandemic and October 2008. Interesting. And the decline was extremely sharp. Here you go. Here's the consumer. Look at that decline. The mainstream analysis missed the correlation between confidence and markets broke down in 2019. Notably, while the Fed is engaged in monetizing $120 billion in debt monthly, higher asset prices isn't inflating confidence. So here's now the asset prices, and here's the confidence. You can see taking a sharp drop. The breakdown of consumer confidence will likely show up in consumption in the coming quarters, which such is mainly due to stimulus and other financial supports fading. I'm telling you 100%, man. And gap between stimulus-driven sales and employment, all kinds of great charts. The problem for the Fed, over the next couple of weeks, all eyes are on the Fed. They're going to start tapering. Lately, there's been an abundance of communication from the Fed to taper, as Morgan Stanley recently noted. The July Federal Open Market Committee minutes suggest there's a strong consensus in the Chair Powell's indication that tapering is therefore much firmer. We could see that as consistent with the FOMC gearing to move on to tapering soon. All right, such is something the markets are probably not ready for. So far, market participants have ignored weakening market economic data, the collapse of Afghanistan, the rising risk of infections across the U.S. As long as the Fed is engaged in providing liquidity, the risk of missing out outweighs being more conservative allocation. However, the Fed remains trapped in 2 very tough policy positions. The system has elevated inflation levels as indicated by the spread between the producer price index and the consumer price index inflation members. Currently, the PPI at the highest spread to CPI in history. It suggests that producers can't pass on costs to consumers. Not yet. Such equates to weaker profit margins and earnings in the future. However, if they elect to pass on those to consumers, such will raise living costs well above wages. Exactly. That's a conundrum. All right, so we agree with the Morgan Stanley's assessment on the likely path of the taper. When path of least resistance to fall the path most traveled, that is a playbook established in the last cycle, that playbook includes a long-term lead to signal that start, a promise that tapering would be gradual, flexible assurance to the market that tapering would have nothing to do with the timing of the first rate hike. Indeed, the Fed did not first raise rates until 6 months following the end of tapering. Therefore, it should also be not surprising if the Fed starts tapering their bond purchases. The market tends to witness increased volatility, which is really what we're going here now, 100%. So Currently, investors are highly confident. Okay, so the point being is the economic growth just did not come from the ease of money, and this right here is where modern monetary theory just loses it, because this is essentially the MMT. I mean, the Fed printing money like a freaking just like a drunken sailor going to a strip bar, man. I mean, this is insane. So the problem is that the Fed cannot print its way to growth. You can't tax your way to prosperity. You can't print your way to prosperity. And even worse than that is the asset inflated prices only affect a certain select few, which is what inflation always does. And the asset price is inflationary. It is. Inflation is in asset price increases on homes, on stocks, on bonds, on Bitcoin, on baseball cards. That is inflation. Very few people in the overall scheme of things are benefiting from that. You know, the top 20%, of which I am part of that for sure. Many of you might well be too, but a lot of people are not. So you have this asset inflation and that, but no economic growth. That's not sustainable. And we've printed money till we're blue in the face. These things aren't sustainable. The point being is the Fed to continue to rely on the Fed is a cycle of insanity, going back to spur economic growth. Remember, they always said the deficit doesn't matter if we can grow our way out of it. We're not growing our way out of it, man. We're not. Slow growth is coming. Deflation is coming. I'm telling you, man, Japan is going to be here at the end of the day. If you haven't taken some profits yet, I don't know what you're doing. That's market timing. Look, dude, at the end of the day, I'm 100% stocks, but I got a nice little cash savings account now, which I like, and I'm trying to build to it too. So I'm investing in stocks, paying down debt, cash. Stocks, debt, cash. Stocks, debt, cash. But I'm going to still continue to earn an income for at least another 9 years. If you're just a couple years out, what are you doing? All right, love your thoughts. We'll see you.